cost of goods sold and closing stock trading account revisited. The trading and profit and loss account prepared as to the profitability from the basic operation of business enterprise. It is reproduced for further purpose. So now let us take an illustrative table here. When coming to the trading account of Ankit for the year ended 31st March 2005, and we have following entries here. In the debit side, we are going to record the expenses and losses, as we have purchases 75,000, wages 8,000, gross profit 42,000, and total of debit side is 1,25,000. And credit side again we have sales 1,25,000. By this illustrative table, we are going to see that how we are going to ascertain the cost of goods sold. If there is no opening or closing stock, the total of purchases and direct expenses is taken as cost of goods sold. So in our example, notice that the purchase amount is rupees 75,000 and wages amount is rupees 8,000. Hence, the cost of goods sold will be computed by using the following formula. So here the formula will be cost of goods sold is equal to purchases plus direct expenses. So where purchases we have 75,000 and wages we have 8,000. So wages is what? The direct expenses. So when we add this both, it will be coming to 83,000, which is nothing but cost of goods sold. So here, as there is no unsold stock, the presumption here is that all the goods purchased have been sold. But in practice, there is some unsold goods at the end of the accounting period. What it means here, when coming to this particular example, we don't have any opening stock and we don't have any closing stock. In our example, let us assume that out of the goods purchased amounting to rupees 75,000 in the current year, Ankit is able to sell goods costing rupees 60,000 only. In such situation, the business will have an unsold goods which is costing to rupees 15,000 in hand, also called closing stock. The amount of cost of goods sold will be computed as per the following equation. So here, cost of goods sold is equal to purchases plus direct expenses minus closing stock. So when coming to the previous equation or previous formula, we never had that closing stock. So the formula was directly purchases plus direct expenses. In case when we have closing stock, according to the particular example here, Ankit is able to sell goods costing rupees only 60,000 and leftover 15,000 will be the unsold stock, which is closing stock. So here it will come to purchases is 75,000 plus direct expenses wages are 8,000 minus closing stock is 15,000. Now as a result, the amount of gross profit will also change with the existence of closing stock in business from rupees 42,000 to 57,000 in this particular example. It may be noted that closing stock does not normally form part of trial balance and is brought into books with the help of the following journal entry. So where closing stock account debtor to trading account. This entry opens a new account of asset, that is closing stock of rupees 15,000, which is transferred to the balance sheet. The closing stock shall be an opening stock for the next year and shall be sold during the year. In most cases, therefore, the business shall have opening stock as well as the closing stock every year, and the cost of goods sold should be worked as per the following equation. Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock. Now let us take one illustration and work out on that, and we'll prepare a trading account from this following information. So where the illustration is compute cost of goods sold for the year 2005 with the help of following information and prepare trading account. So by preparing trading account, and we have to find out the cost of goods sold by applying the equation. So now we have following entries here. Directly we can post this entry to the trading account. So let us take first table of the trading account. So where we will be having particulars amount and particulars amount. Instead of particulars, even we can write expenses and losses and amount, again incomes and gains amount. So it means that we are going to apply the nominal account rule here, debit all expenses and losses, credit all incomes and gains. So let us start from the first entry where we have sales, which is 20 lakhs. So here sales is nothing but an income for the organization which will be recorded in the credit side. So we are going to record it in the credit side, sales 20 lakhs. If we have any sales return, that has to be deducted from this particular entry. So here sales in the credit side in the amount column 20 lakh. So again the next entry we have purchases, then we have wages, and then we have stock. So now we have a practice of recording first stock in the debit side. So whenever coming to the debit side, first entry we are going to record is the opening stock. So let us consider the opening stock in the debit side first, where we have opening stock as on April 1st 2004, which is 3 lakh. So that will be recorded in the debit side. So the entry will be to opening stock, or the stock is enough, so stock account it will be 3 lakh in the amount column. Then we have purchases, again purchases will be recorded in the debit side, purchases in the amount column 15 lakh. Then we have wages, wages are nothing but the direct expenses, again it will be recorded here, wages in the debit side, amount column 1 lakh. Then we have stock as on March 31st 2005, 4 lakh. So when opening stock is recorded in the debit side, and closing stock will be recorded in the credit side. So coming to credit side, closing stock, and the balance will be in the amount column 4 lakh. Then we have freight inwards. So freight inwards is an direct expenses which will be recorded again in the debit side, freight inward in the amount column 1 lakh. After recording all the transactions, we have to see that what is the gross profit we are getting. So here while computing for the gross profit, we have to consider all the debit credit side totals and the debit side totals. So here when coming to the ascertainment of cost of goods sold, same information we can produce in the one table, and directly we can apply the equation. So when coming to the equation, we had opening stock plus purchases plus direct expenses minus closing stock. So directly we can apply the equation here, where opening stock given in the sum is we have 3 lakhs. Then to that we are going to add the purchases and direct expenses. So purchases is given 15 lakh, then direct expenses given 1 lakh we have for freight inward, and 1 lakh we have for wages. So now when coming to addition of all these things, the total will be coming to 20 lakh. Out of these 20 lakhs we are going to minus 4 lakh rupees, which is closing stock. If we deduct 4 lakh, then the balance will be 16 lakh, which is nothing but cost of goods sold. Again coming to trading account, whatever information we have recorded, then we are going to close that particular account to ascertain the gross profit. So here credit side we recorded sales and closing stock, which is 20 lakh and 4 lakh, and coming to debit side we have recorded opening stock, then purchases, then freight, then wages inward. Then the total will be excess in the credit side, we have 24 lakhs, and debit side total is less. So we are going to consider the total of credit side for same for the debit side, 24 lakh and 24 lakh. 24 lakh minus all the entries what we have in the debit side, and the balance will be 4 lakh, which is nothing but gross profit. So gross profit 4 lakh rupees above the total. So concept is very clear here. Whatever entries we have recorded in the credit side is nothing but income, and whatever entries we have recorded in the debit side is nothing but expenses. So here our income is more and expenses are less, and the difference amount will be considered as gross profit. Let us take the illustration and we'll prepare trading account and profit and loss account. So here the illustration is from the following balances obtained from the few accounts of H. Balaram, prepare trading and profit and loss account. So now first entry we have here stock on April 1st 2004. So it is nothing but the opening stock which we are going to record in the debit side of trading account. So coming to debit side, the entry will be opening stock and the amount will be written as 8,000. Then we have purchases for the year. Purchases will be recorded in the debit side. So purchases 22,000 in the amount column. Then we have sales for the year. So sales is nothing but a source of income that will be recorded in the credit side. So coming to credit side, sales in the amount column 42,000. Then we have purchase expenses. So purchase expenses are those which are incurred in the place of production. Since it is a direct expenses, we are going to record in the trading account. So coming to debit side, purchase expenses in the amount column 2,500. Then we have some more expenditures here, as we have bad debts, rent, discount allowed or commission paid. These all are indirect expenses we are going to record in the profit and loss account. Then we have salaries and wages. Salaries is nothing but an expenses which is paid for the employees, those who are working in the organization. Since it will become indirect expenses, we are going to record in the profit and loss account. Then we have advertisement, sales expenses, repairs. So these are the expenses which will be coming in the indirect expenses. So it will be recorded in the profit and loss account. Then we have closing stock, which is 4,500, which will be recorded in the credit side, closing stock 4,500. The trading account, we have to close the account and we have to see that whether we are getting gross profit or gross loss. When we consider the total of credit side, the total we have is 42,000 which is of sale and 4,000 which is of closing stock. So the total of credit side is 46,500. When compared to the debit side total, it is less. So the same total we are going to write in the debit side in the same line, 46,500 minus all the expenditures what we have. The leftover amount will be considered as gross profit. So here the total we have is 46,500 above all the entries minus, then the balance will be 14,000. So that will be gross profit carried down, and the same will be brought down in the credit side after the total. Then it will be gross profit brought down 14,000. Coming to the question, again we have some of the leftover entries which we are going to record in the profit and loss account, because those are the indirect expenses which were incurred in the organization. So we have salaries and wages, which is 3,500, which is an expense again, which will be recorded in the debit side. Then we have rent 1,200, again in the debit side, rent 1,200. Then we have advertisement 1,000, again expense in the debit side, advertisement 1,000. Then we have commission, then again commission will be recorded in the debit side because it is again an expenses. So commission paid 1,100. Then we have discount allowed, again it is an expenditure, here it will be recorded in the debit side, discount allowed, and the amount will be 600. Then we have bad debts, again it will be recorded in the debit side, bad debts 1,200. Then we have sales expenses, which is 600, again expense in the debit side, sales expense 600. Then we have repairs, again in the debit side, repairs 600. Then after recording all the entries, we have to see that again we are getting profit or loss. So as we recorded the gross profit in the credit side, the total we have is 14,000, and compared to the total after the total of trading account, the total of debit side is less. Same total we are going to record in the debit side, 14,000 minus all the above entries, will be getting balance of 4,200, which will be considered as net profit. So in the debit side, net profit 4,200, in the bracket we can write transferred to capital account.